Today, we're seeing the most compelling opportunities in the hospitality space, and we're also starting to see some early opportunities in a more distressed form in the retail space. Starting with the hotel space, clearly, just given the capital pressures, the liquidity shortfalls in that space, we're seeing opportunities to provide either rescue capital or, in some cases, to acquire loans from banks looking to shed some of their exposure in advance of regulatory changes. So, as an example, there, we recently acquired a loan on a newly built hotel in the Northeast from a global bank that was looking to get ahead of some of their challenged assets, if you will. In this case, this wasn't a deeply distressed non-performing loan, but it certainly was one that was technically in default. So in this case, the bank wanted to shed some of that default risk before having to take any sort of risk reserves against the loan and instead decided to sell it. So we acquired the loan at a discount to par, and the seller actually provided financing as well on the position. Now, why we like this position is that we're essentially coming in at over a 30% discount to the borrower's basis on this newly completed asset. Broadly speaking, when we look at the hotel sector today, the market is typically underwriting a return to 2019 revenue levels by 23, 24. Looking at the retail sector, it's early days in terms of opportunities there, but we are under contract to acquire an asset today at about a 50% discount to where the asset was under contract just before COVID. Now, to us, that is the type of quantum you need to see in pricing changes and corrections in the retail space for new ideas to make sense. In this case, to convert the property, at least partially, into residential uses. Again, we see that as a compelling opportunity that will build over time as distress builds in that sector, but you do need to see a significant pricing correction from pre-COVID levels for those opportunities to make sense. Investors can take advantage of the opportunities in commercial real estate, both from a debt or an equity perspective, in a number of ways, just given the massive dispersion we're seeing in the sector today, the uncertainty we're seeing, at least in parts of the commercial real estate sector today, as well as the general liquidity shortfalls that at least some parts of commercial real estate are experiencing today. So starting with the equity side, there's offensive opportunities in the industrial space, in the residential space, to develop or redevelop assets, just given the growing demand from a capital perspective in those sectors and positive fundamentals, if you will. Conversely, on the distress side, again, just given the lack of liquidity in the hotel space today, some of the building pressures that we're starting to see in the retail space, we do expect to see attractive opportunities from a development or redevelopment or repositioning perspective in those sectors. Turning to the debt side, just given COVID's impacts that have kept a lot of lenders on the sidelines post-COVID, what we're seeing is an opportunity for those with capital to generate loans at attractive levels through a number of different means. Number one would be rescue capital. So in the case of hotels or other assets that need short-term bridge financing, that's an opportunity. As well, any sort of new acquisitions that we're seeing today or new developments, if you will, attractive debt opportunities there. And lastly, in select cases, opportunities to acquire notes from banks looking to reduce some of their exposure. Again, those banks looking to get ahead of some of the challenges that they face. In those types of situations, again, what we like about the debt space is we're seeing opportunities today to come in at post-COVID valuations at lower loan-to-value ratios than we were seeing pre-COVID, and in many cases at spreads that are 100 basis points plus wider than they were at pre-COVID levels.